Well, good evening, everyone. We have a small group this evening, but we are going to get right to it, and we're going to talk about tonight how to prepare a loan package. Since we do have a small group, feel free to engage and ask your questions as we go along. If you'd rather put your question in the chat at the end of the presentation, we will address those questions in the chat as well. So get my presentation pulled up here. And we can get started. How's everyone doing tonight? Thumbs up? Good?
Good.
Wonderful, wonderful. So this presentation is being brought to you by the Small Business Development Center. We are located here at Columbus State Community College. We are going to be talking tonight about funding your business, the complete loan package. I am a certified business advisor here, specializing in access to capital. I oversee a Kiva crowdfunding program, which is a funding option that we have, a small microloan program. I'm Growthville certified and also a serial entrepreneur, so an entrepreneur like you. My name is Ellen Harvey, and I'm going to be your presenter this evening. If you are not familiar with the SBDC, let me give you a little bit of background. So the Ohio SBDC is an economic development entity, and they joined Columbus State Community College back in 2004 for this to be our home, and we have been providing services from Columbus State since. We are a part of 1,000 offices nationwide, and there are SBDCs located in 25 different states. We serve Central Ohio, so Columbus and including surrounding counties, so an 8-county region total. We offer our services at no cost to you, and that includes consulting and training like we're doing this evening. We serve your small business from the very beginning, your idea, concept, launch, to succession planning at the end. We also have in our Small Business Development Center export assistance that's available to you as well if you're looking to begin exporting of any products outside of the United States. So again, this evening, our topic is the complete loan package. We're going to talk about the loan package preparation and review, required content and documents, standard templates that you may see within the loan package. And then we'll have some opportunity for us to talk about what questions you may want to ask the lender as you're looking for a lending institution that's best for you and your needs. This class will equip you with the necessary skills and knowledge to create a loan package that meets the requirements of any lender. You'll receive an overview of the necessary content, documents, and standard templates as we review those. There's going to be at the end of the presentation, you'll receive the slides as well as a document checklist that has links to these contents that's in this presentation this evening. This will prepare you to confidently seek funding to start or grow or expand your business. So that's hopefully what we're wanting you to walk away from this class is some confidence. Because the age-old problem is that asking for money is always a challenge. And when we talk to small businesses about what one of their largest barriers is, it is asking for funding, seeking funding, especially in the early stages, because they don't have any proof of concept, they don't have any sales, and so therefore it's a challenge. It's very crucial to be prepared when you're going to seek for funding. And so a lot of what we talk about this evening is how to prepare for the ask. We're going to be addressing such details of knowing the borrowing process, that you are the business, and therefore you need to know your business. So Often we see where individuals will have someone else write the business plan for them. And then when asked questions as far as about the operations and the structure of the business, unfortunately, they're unable to answer those questions because they've not actually taken the time to draft the plan. We are beginning now to see Chat GBT and other AI types of programs or writing business plans. Again, it's very important that you understand and are being able to articulate your business idea and concept to the lender. Again, we're going to go over what's a well-prepared loan package, what's going to be in there, understanding how a lender will evaluate that loan request, and teaching you how to articulate what you need to bring to the table, right, in presenting that loan request to the lender. Couple of things I want to touch on right off the bat is that, first of all, there's no such thing as 100% financing. So if you're seeking funding for your loan, you will need to have some money invested. We call it owner's equity, skin in the game, owner's investment, and typically that's around 10%. So if your loan request is for $50,000, the lender's going to want to see that you have at least $5,000 set to the side that's liquid, sitting in a checking account, savings account, something that easily can be liquidated. Second, your personal credit history is important. Your personal credit is going to be pooled. It's going to be evaluated. Lenders are going to be looking for certain credit scores depending on the loan that you're looking at, the type of loan program you're going after. That range can be as low as 580 when it comes to a small micro loan, and then as high as a 700 for an SBA 7A loan. Bruce, we have some writing going on the presentation.
I apologize. I didn't mean to do
that. Third, you will be asked to do a personal guarantee, meaning that you'll be signing as a co-borrower on behalf of the business, as the business is really perceived as its own, it's perceived as its own person, its own entity, right? And so therefore, the business, especially if you are a new business or a startup business, you haven't established yourself. The business doesn't have credit. It can't prove financials to show the ability to pay back a loan. And so therefore, they're going to be looking for that personal guarantee. So they're going to be looking at your personal assets, liabilities, your personal credit, and they're going to ask for you to sign as a personal guarantor. So look at it the same as a co-borrower if you were signing for someone to buy a car. Fourth, there is no government grants for individual small businesses. So there is no grants out there that are available for small businesses just to get started because you're a minority or you're a woman or anything like that. Now, I'm putting it that way because in general, that is the case. No, there is not. That's typically going to be the answer that you hear. However, there are times, rare, that there are grants that come available. They usually are industry driven. And they're very competitive based, meaning that you're competing against many other businesses for funding. It's typically small amounts of funding, not normally enough for what you need to actually operate your business. I'll give you an example of a grant that's specific to a certain industry, which would be farming. So there are grants that are available for farmers through the USDA. Again, they're competitive based. They require matching dollars. So if they gave you, for example, 3, they're going to want you to have 3 as well. So the best thing to do is just to think that there is no grants available and pursue funding the way that you need to through a loan. And then if a grant opportunity comes available, then that's phenomenal. But don't let it hold you back while you're trying to find grants to actually fund your business. And lastly, the Small Business Administration, the SBA, you'll hear that quite a bit as you begin to look into pursuing funding for your business, or if you've already been in business and have taken out loans before. The SBA, Small Business Administration, provides backing for loans and loan products. So the loan products that they back are microloan programs, They also support the SBA 7A program and the SBA 504. Now, they don't do direct lending, which means they're not the ones who are providing you the funding. They are in partnership, in contract with lending institutions that are supporting their loan products that they offer, this backing that they provide. And so that could very well be a bank, credit union, or a CDFI that would offer an SBA backed product. The SBA is involved simply as a guarantor, meaning they're helping to limit the risk that the lending institution is taking and helping to support small businesses. It's been around for years, and it's been a very important resource to be able to assist small businesses. Purpose of funds. Okay, let's get to it. When you are thinking about going for a loan, one of the first things that you need to do is define the purpose of the funds, how those funds are going to be used. Is it going to be used because you're starting up your business? Is it going to be used for expansion? Is it for real estate or fixed assets? And then is it to support you as a service-based business or a product-based business? So the purpose of the funds and what they would call a use of funds statement is going to detail how you're going to be using funds. A lender will review your financial requirements based primarily on two types of capital infusions: working capital and growth capital. So the reason why you're defining that purpose of funds is because they want to see where you're at, again, startup or expansion, and how you're utilizing those funds, how you're leveraging those dollars within your business. Remember, I had mentioned that you're also going to have an owner's injection, owner's equity involved in the transaction. So even as an existing business, if you're seeking funding, the lender's still going to want to see that you have 10% that you've at least set aside, because you know you're in growth mode, right? So if you're expanding and you're looking at buying another piece of equipment that maybe helps with productivity, and you're needing to hire on another person and buy this piece of equipment and so forth, and you need $50,000 to do it, they want to see that you've been saving up some money as well and set some money aside for that expansion. And maybe you should have maybe $5,000, that 10% set aside. Working capital is used to meet fluctuating needs that will be repaid during the company's next full operating cycle, which is generally a year. So working capital, if you're needing money just to cover like payroll cost, day-to-day activity, as you're getting some more day-to-day activity and expenses related to those, as you're getting some more revenue coming in, that working capital loan very well may be a line of credit that they will advance to you versus what's called a closed-end loan. Once you borrow it, you don't, as you pay it down, nothing is available to you. You're just constantly paying towards the principal to pay it off. But with a line of credit, like a credit card or a home equity loan, as you're paying that back, that money becomes available to you. So you can use it as you have fluctuations in your business and you need some capital to hold you over till a better time. A lot of businesses are cyclical. And so sometimes they are better during a certain time of the year than others. And so there's a period of where cash flow, and cash flow is the amount of money coming into the amount of money going out, is lower. And so there's some coverage there that you need in a working capital loan. A line of credit for working capital often is the right choice there. If you're looking to do expansion, that capital is usually to secure pieces of equipment. Maybe you're looking to buy a building. Maybe you're looking to get into another space or new markets, and you need larger sums of money. In that case, they're going to be looking at giving you probably a closed-in, what we call term loan, and it may even be this SBA 7A loan. So this loan that's backed by the SBA to help support your growth offers you a little lower interest rate. So when you're defining the uses of funds and the breakdown of the purpose of the funds, you're going to break it down: working capital, equipment, new product launch, marketing and rebranding can even be an option, right? So maybe you're needing to revamp your website or have your website created. You need some new collateral materials, whatever it might be. You're going to want to break that down. And then if it's startup cost, when we talk about startup costs, we're talking about everything that is to get you started, licensing, of course, the website, insurance for a year. If you're getting into a new space, security deposit in the first month's rent, then working capital to at least carry you for 3 to 6 months. So again, you're breaking that down so they know specifically why you're needing those funds and how they're going to be used. So the purpose of the funds and breaking that down with the use of funds is allowing them to understand how that money is going to be leveraged within your business. With it, not only could you do like an Excel spreadsheet that would break that information down with numbers, but then you could also write a narrative along with it that explains how those funds being used is going to help your business. So example, you're going to say that you're going to have $20,000 going to payroll. You're going to explain the $20,000 going to payroll was because you're in expansion mode, your sales have increased, and that you're needing to hire some more staff to be able to meet demand. And so you have been able to create a job. Maybe it's just a part-time position that's going to allow you to keep up so that you can maintain your good image and brand within the marketplace. It could be a piece of equipment. And so on your purpose of funds, you have that you're needing some equipment. The use you're having that the equipment is to increase productivity. And it is to cut down on the costs, because where you used to have a product that you are selling, maybe developed or manufactured someplace else, now you're able to bring it in-house. So you're putting the information together numerically, and then you're also putting a narrative together with it as well. Collateral. So collateral is what you're pledging for if you were to go in default on the loan, right? So if you weren't able to, for some reason, to make the payments and the bank needed to obtain some of their money back, they would go through the process of selling off whatever you've pledged as collateral. And so collateral for a small business loan is things that are of value within the business. Examples of collateral, for example, can include a variety of such things. Of course, real estate. So for a small business loan, you may be looking to buy a piece of real estate in which your business is going to operate. With SBA loans, specifically SBA 7As, if you are a homeowner, again, remember that you're signed as a personal guarantor, as a co-borrower. If you're a homeowner, they often, if you have a loan request above $150,000, they're going to be looking to secure a lien against your home. So that becomes collateral for your business. If you are looking to get a working capital loan, your accounts receivables could be pledged as collateral. If you are securing a contract, the contract could be used as collateral. A contract of which you're going to get paid for delivering a product or service, and you're needing the money to be able to provide the product or service to the company that is contracted with you, and you need some funding to make that happen. You could use that contract as a collateral as well. If you were buying a piece of equipment, for example, a van, you're doing some transportation service and you need to have a van. The van itself can be a collateral, and then a combination of all these things: inventory, supplies, large pieces of equipment, titled equipment, and real estate. All of those things can become a part of the collateral package so that the bank feels comfortable in providing funding to you. And then you yourself, right? You yourself is considered collateral as well, because they're going to be looking at you to make that payment. So when the business doesn't have enough sitting in their checking account, they're going to be looking to you to come out of your pocket to make the payment. So they very well, in assessing your ability to help the business, they may very well look to see if you have a second job that you're going to maintain while you're getting the business off the ground. If you've maintained a current job that you're going to keep and maybe work in the business part-time as you're getting the business to a place where you're comfortable to make the transition full-time. If you are sitting on assets of your own, retirement account, money in savings and so forth. And life insurance, even with a cash value, all are things that you can show and represent that you have assets and the ability to pledge and be a good guarantor on a small business loan. So I mentioned as I was going through how funds would be used and how a lender may look at the type of loans that will offer you. Now we're going to talk a little bit about types of loans. So knowing the loan, the terms that can be offered by the bank is crucial. So you want to ask questions. And the shorter the term, now when I'm saying term, I'm talking about the repayment period, right? So if you buy a car, you typically buy a car for 5 years, 60 months or 72 months. And so that's the term of that loan. Same thing goes with a small business loan, is that you want to think about the term, because the shorter the term, the higher the payment, right? The higher the interest rate, the higher the payment. And so why this is so important, not only for qualifying for the loan and making sure that you have enough revenue coming in, if you're an existing business, you have a positive cash flow to be able to handle the debt. If you're a startup, making sure you have a secondary source of income, or the business is one that can quickly get off the ground and your projections make sense to be able to cover the debt. Why it is so important, and when you're thinking about looking at loan products and evaluating the terms and the rates, in some cases, the term of the loan will take more precedence for you than even the rate, because the shorter the term, even though you may have a lower rate, the payment may be higher, much, much higher, which it impacts your cash flow, right? Your money coming in, your money going out. Where even though a rate maybe 2% higher, you're like, you kind of cringe, but at the same point in time, it may offer you a term from 6 years to 10. And that extra 4 years makes a big difference in your payment. And therefore, it doesn't impede or impact your cash flow as much. And so when you talking about a small business, some small business operations, everything is about cash flow, making sure you have enough money from month to month to handle expenses, handle the ability to get your product or service out there for you to be able to go to the next month. And not having a good cash flow can really, truly hurt you. So term is always very important when you're thinking about your loan that you're looking at for your business. As you're looking at a loan, you are preparing to go after a loan, you want to think about high monthly obligations and that you currently have personally, and as well as in the business, and see how you can maybe make some cuts. Okay. Especially if you're a startup business, before you start seeking a business loan, you want to really take a look at your personal credit. You want to evaluate that, and you want to start paying debt off, paying down credit cards, because your credit score is going to be important. But not only that, when you're first getting a business started, the money's not coming in right away. You know, it takes time. It takes time to build up your business. It takes time to start bringing in revenue, not only just to break even, and that means just having enough money to cover your expenses on a monthly basis, but to be profitable to where you can actually put some money back into your pocket and you can handle some other things. So you've got to be very conservative when you're going into the idea of starting a business. Same thing goes when you are looking at expansion. You want to really evaluate, and you should do this anyway, every so often, personal and business. Go back, look at your accounts, look at your vendors, look at who you're using, and see how much you're being charged for certain things. Evaluating what your fees are for your checking account, evaluating what your fees are for your point of sale services, evaluating what your vendors are charging you. The term cycles, even vendors, if you're buying supplies from them, if you are on a net 15, meaning that you got to pay them within 15 days, maybe they'll allow you to stretch that out for 30 days. Even that helps buy you more time, but it helps you to show a stronger and give you ability for a better cash flow. The timeline of which you're going to need a loan. If you are looking at expanding your business in the next 3 months, for example, you should have started 3 months ago, because it takes anywhere from, I'd say, on the plus side, 60 days up to 120 days to get financing for a small business loan, depending on the lender, where they're at, if they're backed up, if they've had any turnover of staff. It takes that long. And so you don't want to be asking for funds when you absolutely need them. You need to be asking way before you need them. And so a part of that is planning ahead. For a startup business, if you have been going back and forth with an idea, you have put things in place in preparation and so forth, and then all of a sudden you wake up one day and like, I'm ready to go. And let's say it's a food truck, okay? And it's now August, and you're like, well, I want to do a food truck. Well, you're not going to get funded probably till December. And so now you would have this truck in operations in December, and you wouldn't be able to make any money. Spaces for food trucks are more limited during the wintertime. The weather is going to be an issue for you. There's a whole variety of different things that you want to think about timing when you're looking at pursuing funding. Always asking for money before you need it, and planning about how your business is as far as if it's cyclical, and then looking at how fast this money is going to be able to get to you in applying for the loan. So again, one of those questions you may ask the lender is, what is their turnaround time from once they receive a full package? Because they don't even start underwriting until you've gotten them everything. So we've talked about a term loan, which is a closed-end loan. You borrow the money, $50,000, you pay it back over a certain period of time. That's it, it's over. Line of credit, you're borrowing a certain amount or having a certain amount available to you, acts as a credit card. As you pay it down, it becomes available to you again. Real estate collateralized loans, regular collateralized loans with inventory equity, contract type loans, all are various different types of loans and terms. In most cases, loans are going to have some kinds of fees involved with them. If it's nothing more than an application fee, there may very well be a fee. Often though, there's application fees, there's a loan commitment fee, there's prepayment penalty fees. And so you want to ask, what are all the fees that are involved in the transaction so that you are prepared? Sometimes those fees are paid out of your pocket up front. Sometimes those fees are refinanced into the loan itself. If you're going for real estate, there's a tremendous amount of fees that are involved versus if you're just going to get a loan to buy a truck, right? Then you would just have title to get the truck, and then you may have an application fee and you may have a commitment fee. Now, fees up front is one thing. At the end of the loan, those fees is called a prepayment penalty. So fees up front are your application, loan commitment, so forth. Any recording fees for mortgages and title liens, things like that. At the end, it's called a prepayment penalty fee. So a prepayment penalty, if you've never heard of that before, is a fee that's charged to you for paying off your loan early. Well, you may think, well, that's just ridiculous. If I can pay my loan off early, why wouldn't they want me to? Well, they're losing money. So to offset the fact that they may lose money because you pay your loan off early, they're going to charge you a penalty. And typically it's anywhere from 1 to 5%. And so with these SBA products, especially the SBA 7A, you want to be real careful because a lot of lenders will have, and they're allowed to, charge you a prepayment penalty on those loans. And it can be as high as 5%. Now it may reduce as time goes on, but it could start as high as 5%. So if your thought is, I'll just hurry up and get this loan, I've got this large contract, I won't need it in 6 months and I'll pay it off, you might want to give that some consideration that you leave it in place for a while. You being able to write off that loan is not a big deal. It's going to give you some write-off as far as against what you potentially would be paying on taxes for the profitability that you have in your business. So it's not going to hurt you to leave that debt out there. And in fact, it may be offset the interest with the taxes that you would have had to pay if you didn't show that expense. Don't forget your loan payment. So, okay, so again, you're asking about terms, you're asking about rates, you're asking about fees. Now you want to ask, well, what's my payment? What will my payment be? And you want to know what that payment would be because one, of course, you need to know what it is so that you know how much you're going to have to pay back. But in addition to that, you need to work that into your cash flow. One of the things that the lender is going to ask you for as part of your financials is a cash flow, and you better show that payment in there. Often we'll see a cash flow and there'll be no payment for the loan they're asking for. I'm like, well, who are you paying them back? Or are you just not going to pay them back? And it's oblivious to like, oh, I didn't even think about I need to put the payment in there. Absolutely. Whenever you're looking at borrowing funding from a lender, you're always talking about how you're going to pay them back. And so making sure that you know what that possible payment would be. There are loan calculators that are online that you can quickly put in the loan amount, the term, and the rate. You can calculate it yourself or talking to the lender, know what that payment potentially could be. Okay, there are three major components of a loan package. The business plan. So in the business plan, there is going to be a statement of purpose, and I'll come back to that. You're going to have all the documents that are going to be needed. We're going to go over a checklist, and then your financials. So that's the package, right? And then they're going to give you some application documents. But the parts that you're going to come up with is this business plan, and yes, you're going to need a business plan. The relatable documents to it, and your financials. So in the business plan, you're going to have everything that comes with the business plan, the executive summary, and I'm going to come back to that, but you're going to have the executive summary. You're going to talk about your product, your service, how it meets a certain demand, why you think your product is good, who your market is, what kind of what's going on in the industry, how much you're going to capture of that market share, how much you're charging for your product or service, how many customers you're going to have to be able to serve to break even, the cost of operations of your business from day to day. All of this is going to be a part of your business plan. Even your resume is a part of your business plan. You're tweaking the resume for the position. So now you're an owner of this business. And so your resume needs to reflect all the experience that you have, not only to launch your product or idea, but that goes along with operations of business, any management, supervisory experience, HR experience, marketing experience, everything that it takes to run a business, because it's not about just your idea. It's not about just your product or your service. It's about you being able to run a business. So you're doing two things at one time, learning how to operate and run a business, as well as getting your great idea off the ground. So in that business plan, all of that is taken into consideration. So you're adding your resume, you're adding key people, you're adding their resumes, you're adding pictures of your product, you're talking about servicing, how you've got certain certifications, degrees, the licensing, and so forth. Telling your story, right? Everything about your story. Now, what's the most important part of the business plan, with the exception of your financials? It is your executive summary. And in that executive summary, you're going to put your statement of purpose. And that statement of purpose is why you're needing these funds and how much you need. Do not go to a lender and say, I need a loan. And then the first question they're going to ask you how much you need. And you're going to be like, I don't know. And they're going to be like, why are you here? Because you need to know how much money you're going to need. That needs to be a part of your executive summary. That needs to be a part of your statement purpose. And the statement purpose, it changes from who your audience is for the business plan, right? So it could be your staff, and your business plan is being presented to them in that statement of purpose, or how it's being presented and is organized such so it's to help your staff to understand your idea. It could be to someone you're going to be renting space from. Again, often if you're going to rent a brick and mortar space, they're going to be looking for you to provide a business plan. They want to know that you have a clearly thought out idea. And then, of course, the lender. So from a perspective from the lender, your business plan needs to be written as such. Again, why you're needing this money, how much money you're going to need comes right at the very beginning, right? And how that money is going to be used. The executive summary then summarizes everything else I just talked about that's in the business plan. And it's 1, maybe 2 pages max. And let me reassure you though lenders may look at your business plan, what they're actually going to read is this executive summary, because it's going to just summarize up everything for them right then and there. From that, if they have questions, they may dig a little deeper into the business plan, but that executive summary needs to be tight. It needs to clearly articulate what it is that you're doing, who your team is, who you are, and why this is such a great idea, and that someone, even that person that's reading it, might buy your product or take advantage of your service. The next thing is the financials. So you'll be receiving a document checklist. And so in that document checklist, we've provided some links, and these are the items that are going to be a part of your business plan that are documents that will be required. So a lender is not going to look at your loan package with documents missing. So it's best for you to prepare your loan package in its entirety and present it in that manner than it is to piecemeal them documents. As you piecemeal them, then more questions arise. If you provide them a clear package, questions answered, you are going to have a better chance of getting through the process. Now, when we're talking about the loan checklist, there's things that are going to be a part of the package that are for you personally, and things that are specifically to the business. For you personally, it would be, if you've ever applied for a home, the documents in the loan checklist are about the same. If you've never applied for a home loan, I'm going to walk you through what you might see. You're going to be looking for pay stubs. And this is if you're already employed and currently employed or receiving Social Security retirement benefits. You're going to have to provide those income statements, pay stubs, W-2s, pension statements, Social Security award letters, anything like that. They're also going to ask on a personal level for your personal tax returns, all pages, and then you typically need to sign that tax return. Even though you've already submitted it and filed it with the IRS, they're wanting you to sign their copy, that you're acknowledging that that is a truthful document, because they will have you sign another form where they can request your documents from the IRS to confirm them. On a personal level, they're going to also ask for a personal financial statement, and we're going to go over that. Personal financial statement, again, allows you to break down your assets and your liabilities. Now, going forward, as we look at the business documents, they're going to be looking at things related to the business. Okay, so business plan, they're going to want to see the cash flow, the financials, which is a cash flow projection, profit and loss and balance sheet. We're going to look at a couple of samples of those. If you're an existing business, then these will be actual numbers. If you are a startup, these will be projections. For existing businesses, they're going to be looking for up to 3 years of filed financials. So if you've not been in business for an entire 3 years, they're going to be looking for the tax returns for the time you have been in business, operating, and have filed your taxes. Your startup date is not when your startup date is when you finally started filing taxes. Let's be clear on that. Many of us have had businesses, including myself, where you may have done little things on the side and you've made money and you said it was your business, but you really didn't file a tax return for it, right? It's more of a hobby. If you're now trying to say that that's a business and you're trying to go after a business loan and you've never filed a tax return on it, though you've been doing it for 5 years, it's not going to be considered an existing business. You are going to be considered a startup, and you will need everything related to a startup business. So again, so financials for up to 3 years if you're an existing business. If you're a startup, again, you're just doing projections, and those projections will also be for 3 years. For existing business owners, you're looking for accounts receivable, accounts payable, current profit and losses, and current balance sheets. You also will need to come up with your business license. I'm sorry, business insurance. So For startups, you'll be getting a estimate, and for, of course, business owners, you will provide your business liability insurance. If you need any licensing, certifications, anything like that for your business, vendor's license, anything like that, that should also be included as far as your package as well. If you're an existing business, you're going to have a letter of good standing from the state of Ohio. And then least but not the last is you are going to have to show that 10% owner available money that you have to put into the business. And so again, that needs to be sitting in your savings or checking account if you're just getting started, so that you're personal. And then if it's the business and you're an existing business, that can be money that's currently in the business accounts, right? That the business can reinvest back into itself. Legal documents related to the business, you're going to need, if you're an LLC, you're going to need an operating agreement. If you're a corporation, you're going to need articles of incorporation. You're going to need your filing with the Secretary of State's office for filing the designation of your company. You're going to need your EIN number, recorded with the IRS. If you're a sole proprietor using your Social Security number, you won't need that. It's not required that you get that unless you're actually paying employees or even W-2ing and paying yourself. Any lease agreements that you have, if you're looking to go into a brick and mortar space, you would not want to sign a lease agreement prior to getting your funding. There is terminology within your lease agreement that often says that the landlord can lien all of your inventory and supplies and everything that's in their space. And that can hurt you when you go to look for funding, because often the lenders are wanting to collateralize those supplies and inventory and equipment and so forth. And so that can hinder you from being able to get financing. Plus, if you are looking to go into a brick and mortar space, you should never do so until you have the funding to be able to pay for it, right? And a part of you looking for funding for expansion or startup is making sure you have enough working capital to handle your expenses while you're getting things off the ground or you're in growth mode. A Duns and Bradstreet number is also going to be required in the checklist. We're giving you a link where you can go and you can get that number. It is also a free cost. So your EIN is free. Your registration from the state, I think if it's on sale, it's $99. And getting your Duns and Bradstreet number is also free as well. There may very well be other documents that they're going to ask for. Of course, their application and some documents that they want specifically, but for the most part, those are the documents that you're going to be pulling together, with the exception of the lender's application, that you can have ready at any given point in time to go to any different lender, to go to a landlord, to share with your team. So now we've talked about what's important. So the business plan is important with that purpose statement, with the summary of who you are and your idea, the documents that you're having to collect as a part of the loan package, very crucial and important, understanding how to read those documents as well, and then these personal financial statements. So the personal financial statements, these statements that you will need, these 4 types of statements, the one we're starting off with is your personal financial statement. And that is for you personally, has nothing to do with the business. The cash flow statement is all about the business, how the business has money coming in and money going out for expenses. So the flow of money through the business, no different than your own personal checking account. You get paid, money comes in, you pay your bills, money goes out. Same concept. The income statement, also referred to as the profit and loss, and your balance sheet are documents that they're going to be looking for. They may ask for some others, but these are the main ones. So the personal financial statement, again, related to you personally, is just a simple balance sheet measuring your net worth. So it's about you, assets, liabilities, what's left. So this is an example of a personal financial statement. That's going to vary from lender to lender. The concept is very much the same. One side is assets, the other side is liabilities. A couple things I want to point out on this, no matter who you get this document from. One, you want to read it thoroughly, okay? So you understand what's supposed to be on this document. Any owners that in your business that own more than 20% interest in your business will be required to sign on any loans. And so therefore they will fill out their own personal financial statement, their own applications, and will need all of their own documents with the exception of the business documents. If you are married, the lender very well may ask for you to separate out your liabilities and assets, or they may ask for you to include them. Again, that's why you want to read this document over in its entirety, because it will be different from lender to lender. If you are including any personal real estate assets, or not. So again, that may not be something that is required for you to put on this document. They may have you put it someplace else. So when we talk about the asset section of this, and we talk about cash on hands in the bank, that's just your money you have in your savings and checking accounts. My recommendation is that this is done at a very certain period of time. So if you do this on September 30th and you just got paid, great. Don't spend any money out of your account yet. Do your personal financial statement, have your bank statement that cuts on September the 30th. So it's showing you at your best and at your best point, right? With the most money saved up. Always remember that this is a document that's done at a very point in time. So that's something you can control of what's in that account at that point in time. If you have an IRA or retirement accounts, you want to put that there. Accounts and notes receivable. This would be cognizant notes. People that you've let borrow money, you have an actually executed note or agreement with them where they're paying you back. That's an asset to you. Life insurance. Life insurance only goes on here if you have a cash value. So a life insurance policy, typically whole life, where you've paid into it, it's accumulated at a value, and that would be the cash value of that policy. You can use that as an asset as well. Stocks and bonds, of course, real estate. Again, do you want to clarify what's supposed to go there for real estate? So this would be potentially your primary residence and investment properties. It would also be land that you may own. Timeshares is another asset a lot of people forget about. That is an asset. Automobiles. Here, you're putting the value of your automobiles, whether they're free and clear or have a lien against them. Your values go here. And then other personal property. This would be things of value, of great value. So this would be jewelry, artwork, like forerunners, things like that, things that would have some type of significant value, lawnmowers, tractors, things like that. So then all this is calculated and added together to give you your total assets. Now, how your net worth is being considered, or how it's being adjusted to figure out if you have a positive net worth or negative net worth, is now we're looking at liabilities. What are you paying out, right? So accounts payable, notes payable to banks and others. So this would be if you have any type of signature loans. If you have any signature loans with banks, you want to put that in this section. If you owe anybody money and you have it under a cognizant note, actually executed a note, then you would put that there. Installment accounts and auto loan. Again, you're putting just the balance that's owed. You're not putting what you borrowed. Other installment accounts could be, again, like a home equity line. Sometimes people will show that over we'll show it under just another type of loan, but an installment loan could also be your home equity line as well. It could also be a signature loan. It could be a loan that you have secured with some personal property, or maybe you took out a loan to get your appliances or some new furniture, not a credit card, but a loan. So you can borrow against the life insurance policy. So if you do have life insurance policy that builds up a cash value, you can often borrow against that, as well as your retirement. If you have loans against your life insurance policies or retirement, you'll also want to list that. And then for your mortgages, if you have a loan against your mortgage, you want to list that. Now, if you are like, I have no idea what my house is worth, right? And you're trying to figure out your value for your asset, just do a quick search, put in your address, and it will give you a value on most of those sites, that real estate sites. It'll give you your value for your area. You can use that. That's fine. Unpaid taxes. So if you have some taxes that are due, here you're going to put the total amount of the taxes that are due, not just the payment. Other liabilities is going to come down to your credit cards. Again, you're putting the balances of the credit cards. Again, because that's debt that you have sitting out there. So the difference between your assets and your liabilities then gives us your net worth, be it positive or negative. As you go into section 1, sources of income, this is going to be any of your personal sources of income. So your salary, pension, Social Security, retirement. If you have investment properties, if you have positive cash flow from your investment properties, and those are profitable, you're going to put that income in there as well. Other investment income would be returns on stocks and bonds or interest that you earn. All of that can be added as an income source. And remember, child support, alimony, any of that stuff. Because remember, again, this is to assess you as a personal guarantor to help your business in getting a loan. So you want to make this look as good as possible. Contingent liabilities are other things that you might possibly have out there where we have a co-signer, where you've co-signed for someone, you may have a judgment or something like that. If provisions for a federal tax lien. If you have things on here that you're like, this may be very questionable, always just draft a letter to go with any document that you have that needs further explanation. Typically, the personal financial statement is a couple pages long. The next couple pages are just going to have you define some of the sections that are on the first page. Here, you're going to be listing that when you acquired certain assets, the current value, how much payments might be on different items and so forth. Just take your time in completing this. You know, as advisors here at the SBDC, we are here to assist you. If you have problems going through any of these documents, you can reach out to us, set appointments with us, and we can help you through this process. We would rather you have a complete loan package, an accurate loan package, and so we are here to assist you with that. And again, those services are provided to you for free. When you're filling out your schedule of real estate, it's going to ask you primary residence, rental property. Very important that you list that, how it needs to be identified. Because again, when they are looking at, lenders are looking at collateralizing their loans, they're going to be looking at everything you have as a possible opportunity to secure some collateral. And then the last page is where you'll be signing. Again, remember that you're doing this around the time that you are looking the most prosperous, and you're going to be signing at that point in time. The income statement or the profit and loss. Now we're into the statements that are a part of the business. And for those that are existing, these are actually going to be factual documents. For those that are existing, you're going to be projecting these. Projections of these are going to be for 12 months. And for an income and profit and loss statement, you'll just be doing them for like year to year. So for example, you would do one for 2024, 2025, 2026, projecting what your income would be and what your expenses would be for that period of time. Again, we can help you with these documents as well. So an income statement is pretty much like a reconciliating your bank statement. And so, again, you're showing money that you have coming in for your business, it's your revenues, your sales. And it's showing then the cost of goods sold. Sometimes you have this, sometimes you won't. It just really depends on how your accountant sets things up for you. And this is what it took to actually sell those revenues, with the exception of just your average expenses. And so that's called your cost of goods sold. And then the gross profit, your gross profit is the money that's left after any costs that go into just the direct cost of goods sold, expenses to actually get that revenue sold. So in this example, our 40,000 is what we brought in, our 40,000 is what we have left. Now, when you go to expenses, it's going to break down every expense that you have coming through the business, from advertising to if you took out a draw as the owner, bank charges, if you're giving money to charity, if you have any contract labor, your credit card fees, all those different things. A lot of business accounts will allow you to code now transactions. So I always recommend that. If you're still just getting started, haven't really gotten into QuickBooks yet, don't feel like you have enough transactions to even think about QuickBooks, learn it. There is not TurboTax, what I want to say. QuickBooks does have a program for self-employed that have very minimal transactions, not a complicated business, called QuickBooks Self-Employed. And it's much, much easier to use, and it can allow you to identify the different categories in your business for expenses, as well as the revenue streams. A lot of banks also have where, like I said, you can code the items coming through your account, and then you can download those transactions into QuickBooks as well. Apologize. In here, you just have other things, right? Payroll taxes, your payroll, sales tax. You don't want to forget that. If you are a vendor selling a taxable item, make sure you're collecting your sales tax and that's being paid. Rent, repairs, so forth, and all of that. So really, it's just what's coming in, what's going out. There are some other things that are in here like amortization and depletion and depreciation. You'll see those more when you're looking at your taxes, and that's just how different equipment and so forth is depreciating over time. The balance sheet is really the business's profit and loss. So the balance sheet is again looking at the business's assets minus the business liabilities and gives us a net worth. Now, the thing with a balance sheet for a business is for every positive transaction, there's a negative transaction and vice versa, right? So if I took out a loan for 50,000, then that is a liability, but it's also an asset because the 50,000 went into my bank account or it bought a piece of equipment or whatever. And so that's how you're going to be thinking when you think about a balance sheet, that's how you want to think about it. For every action, there is a reaction and they equal. So let's look at what that might look like. So we have assets, we have liabilities, we have capital. Capital would be your investment. So in this scenario, we have assets that come to 10, and then we have total, wait a minute, make sure I see the whole picture here. So we have total assets of 56,300, and then we have our total liabilities with our total capital that come to also 56,300. So this is why it's called a balance sheet, because they balance. Now, when we think about what that looks like, again, remember, for every action, there's a reaction. So I'm going to start with the liabilities. So for example, in liabilities, we have accounts payable, $5,600. That means there's money that's out there that's due. Accounts payable, $5,600. That means that's money that you've spent. Money you've spent to do what? Money you spent to make revenue, to make sales. So on the opposite side of this, we see accounts receivable, $4,000. Okay. So that means for the 5,600 that you spent, you've got 4,000 coming in. You've got 300 already sitting in the bank, and you may have a portion of that sitting in inventory. Do you understand how that works? So everything splits. If we look at the asset side and we look at merchandise inventory, $6,000. Okay. So we have $6,000 sitting in inventory, but if we look at the liability section, we have a $10,000 loan note out there. So maybe from that $10,000 note, 6,000 of that went to pay for that inventory that's now sitting there. Okay. So there's still $4,000 left somewhere. So you have to think about, where is it at? Okay. So everything needs to balance when this is all said and done. We have a long-term note, $25,675. I bet that's the vehicle. That's an asset that's valued at $30,000. It's been paid down, so the difference between the two is probably depreciation. Okay, items depreciate, that becomes depreciation. That's something that we take into account and consideration as well. So one side balances to the other side. If there's an asset that's been made, there's something that had to happen to get that asset, be it expenses that was incurred to generate that sale, whether it's a piece of equipment that was purchased, maybe there was the loan that was taken out for that. That's how the balance sheet works. Now, when you see that this is not matching up quite right, it might be because you've been putting money into the transaction. And so when we see that, we see what's called the owner's equity. That means this is money you've been investing, right? So if you're seeing this thing's coming up short, you probably need to put the money that you've been investing back in there. So money you've put into your business that you've not been able to recoup is called owner's equity. And it is your money that you've invested that's still sitting there, okay, that's due to you. So it's both. It's an asset and it's a liability. And so as you can see in this example, you'll see other assets, goodwill, 10 grand. Then you'll see our owner's equity, 10 grand on the other side. These can be a little tricky. Again, we can help you with them. If it's an existing business, your accountant should be able to create this for you. And some of the software packages that you use actually work. They still sometimes even have to be tweaked then. So this is the most important financial statement document, I feel, for a small business owner, and it is the cash flow. So the cash flow is used to monitor, and the project of the incoming, outgoing cash, typically on a monthly basis, helps your lender determine how much cash your business will have at any point in time and be able to handle the debt. So for this example, this cash flow statement for existing businesses, again, this is your actual numbers. For those that are startups, we're going to project it. So this is a startup cash flow. And so if we look at September, we have the 10%, the 5,000, we have the loan proceeds of 50,000, and then we're showing the breakdown of that. So this would be the use of funds here, right? It's all now been nicely fit into the cash flow. And so how is that 50,000 or 55,000 being used? Because again, 5,000 is your own money. Well, 3,000 is going to advertising, 15,000 is going to buy a van, 1,500 is for insurance and so forth. We got 6,000 in supplies, and we've got 37,700 left over for working capital. That working capital flows to the next month. Now we see some sales and again, some expenses coming out. By the end of the next month, we saw a positive ending cash balance of 32,340. Again, we're still working off some of that money we left in there for working capital, and that's okay because we want to make sure you have enough working capital in the deal until you have enough sales coming in to be able to handle your expenses. The one thing I do want you to notice here is now we have the loan principal. So that payment has been added in there. Normally the payment's 30 days later once you've secured funding. So you want to think about that. And then if you're going to be taking any money out, you're going to see an owner's draw. Now, your cash flow should fluctuate. Like right off the bat, you may not be making 30,000. You might only be making 10, and then it's 15, then it's 18. You want to think about that. You want to think about how many sales you have to make, how many products you have to sell to bring in a certain amount of revenue, and it's going to take time to do that. And your cash flow should reflect that. For existing businesses, if you keep up with this, when you go to look at this at the end of the year or every 6 months, you can see different changes and fluctuations in your business, and it can help you prepare. To know when you need to maybe cut some staff, when you need to maybe buy some more supplies, or when you may even need funding. I think we are looking at time here. Let's now consider some helpful tips in pulling this all together. So again, we've got a whole lot going on, right? You're writing the business plan, you're collecting your documents, you're pulling together your finances. Now let's talk about some other things that you're going to be doing when you're going through this package. You want to be brief, you want to be to the point, everything needs to be easy to read. If there's anything that's in question, you want to make sure that you're creating a letter of explanation to go into the packet. Letters of explanation that I've seen have been around credit, have been around dips in income for existing businesses, have been around organizational changes and how that's impacted the cash flow. And most recently, the impact that COVID has had on businesses and how they've had to restructure, how they've had to come back, how they've had to start over. And so whatever there may be in your loan package that would cause question, then you need to address it ahead of time. Again, we're here to evaluate your packages and to help you with that guidance. The information in your loan package should emphasize the management strength of your business, convince the lender that you and your team have the skills and passion expertise to be successful. Lenders really shy away from those that are getting involved in a business that they have no idea, concept, or history of doing the idea or selling the product. So if that is the case and you are starting a business of which you have no experience, but you have some key people involved that can handle the operations of that business for you, you really want to make sure that you're stressing that and providing their information and their skill sets and showing how maybe in your role as just the owner, supervising, managing, you're bringing your skills to the table there. Your loan package should be presented attractively. Projections should paint a realistic picture. As I said, you want to show the growth slowly, and your assumptions should be something that is realistic. So when you're presenting this loan package, when I'm saying attractive is so forth, that means, let's make sure there are no spelling errors, grammatic errors. Let's make sure that we don't have any coffee stains on it, things like that. You'd be amazed. Again, throughout the package, you are representing your repayment plan to the bank, making sure they understand your plan to get them repaid. And the bottom line is here with this is that you are positioning yourself so that you can convince the lender that you and your business are a good risk. That good risk is not only just this package that's well put together, but it's you as far as your character. It talks about your capacity to be able to repay, how you've managed your credit, even if you've had some credit challenges in the past. Again, that credit letter is going to help paint that picture for you. What collateral you do have the pledge, what you've done in preparation, paying down debts, and so forth. And they're going to look at all those things among other factors. Even the people that you bring in to help with the operation of your business will be considered as the lender makes their loan decision, as well as the support that you have from agencies like ours. That's very important as they look at references for you, as they look at advisory boards that you may have, that you are leaning on and counting on the advice and wisdom of others that have done this before or are in your field or industry that you're looking to break into. And finally, every lender does things differently. They have their own taste as far as for different kinds of industries and loans and so forth. So never be discouraged if you get rejected from one bank because another one very well may do the loan for you. What I do recommend, though, is if you are rejected, declined for any reason, is to ask them why. Find out why your loan, your application was rejected. It may be a calculation. It may be that there was something in your package that they weren't clear about. You can change and correct those things, and you may not be able to overcome their objections, but you can make sure it's in place for the next time that your loan is reviewed. You are going to get this along again with the loan presentation, as well as the checklist, some sample questions to ask the lender. I'm just going to point out a couple for you so that we can finish up with our session and take any questions that you may have. So we did already talk about asking about the products, asking about the rates, asking about the fees. The other things that you want to ask about is there any loans that they're not or industries that they are not doing at this point in time? Now that's possible. There was a period of time where a lot of lenders were shying away from restaurants. At one point in time, they were shying away from food trucks. Sometimes it's local convenience stores. So you can ask that question. That's okay. You don't want to waste your time. You don't want to waste theirs. You also want to ask if how long the loan process is, because that's very important, right? So you want to know how long it's going to take once they receive your complete loan package to get through the funding process, and to make sure that you have enough time. And then when is your first payment due, right? That's important, so that you can plan for that. And that can also be a part of your projections. When it comes to collateral, you want to ask them what they're seeking as far as collateral coverage. Do they want 100%? So if you're asking for $100,000, then they want to see you have $100,000 in collateral. Is there a lesser amount that they're able to accept? The state of Ohio has what's called a collateral enhancement program. If you're not going through an SBA loan product, which offers a guarantee and helps offset that collateral shortfall, and you're going through like some type of traditional conventional financing, then the state of Ohio, if they're in partnership with that bank, can offer a product that can offset a collateral shortfall. But you need to know, what are they going to be looking for as far as collateral? If you are a homeowner, are they going to want to take your house? You may not want to pledge your house for such a high risk transaction as far as starting a business. Starting a business is a risk, and so you may not be willing to risk your family home. When it comes to credit, what credit report are they pulling? Rarely do they pull credit reports from all three credit agencies. They normally pull from one credit agency. So you want to make sure that you're evaluating your credit report, making sure that the information is on there incorrect, making sure that your credit score is the way that it needs to be. If you need to pay down some credit card debt, that is the easiest and fastest way to raise your credit score, is by paying down some credit card balances. Never close the credit card accounts, because that actually is going to harm your credit score. Just pay down the balances. For every 10% you pay down a credit card from the high credit, is going to help raise your credit score. Once you get under 50, you're going to see a huge difference. Under 30 is really where you want to be if not paid off completely. Again, not closing out the account. They will likely pull, in some cases, a business credit score as well. How those business credit scores are calculated, I can't even begin to tell you. There's so many factors that go into calculating your business credit score, but they very well may pull that as well. A lot of it has to do with how much money you have invested. Cash flow has something to do with it. And then if you have any type of business credit, easy way to establish some business credit is getting a gas card in your business company name, and you can use that by your name and your EIN. Getting, of course, a bank business credit card, and then also like Staples, Office Depot, Sam's Club, Costco's, some of them offer some business cards as well. A Dell, if you're looking at buying your computers, get the Dell account in your business name. Then your vendors are also going to have credit possibly for you that you would be able to take advantage of. If you have, let me say this before I forget, if you have any type of federal debt, so that would be a VA loan, a USDA loan, another SBA loan, student loans, and you've went in default on those or are behind, that is going to hurt you from being able to get a small business loan. So you want to make sure that if you've had any issues with those kinds of loans, federal government loans, that you get back on track. You either get them into a payment plan, you resolve any outstanding issues, but because you will not be able to move forward with a small business loan with an SBA guarantee if you have any type of other federal issues. Now, there might be some other options out there for you, but not for those products that are backed by the SBA. And so, again, the SBDC is here as a resource for you with several different offices throughout the United States. So if you were likely to move from Ohio to someplace else, there's going to be an SBDC for you. We serve Columbus and the 8 county regions. We're here to help. There's numerous other resources that are here in Columbus and surrounding that you should take advantage of anytime that you can, that provide valuable information and resources to you. You have the Women's Business Center, that's the ECDI. ECDI is the largest micro lender in the United States, so they're here and available to you. You have the MBAC office, which is the Minority Business Assistance Center. They are located over on Mount Vernon Avenue, and they provide technical assistance, some women programs. They provide minority certification, women's certification, veteran certification. So they're doing a lot of work over there as well. You have SCORE, which are mentors that are available to you. Again, free. All these things are free. There's other women's groups, organizations, Chamber of Commerce, that are all available for you to be able to access information about small businesses, to be able to network with other small businesses, to be able to partner with other small businesses and to help both of your businesses. So take advantage of the resources that are out there for you. Next steps, you're going to make sure that your business plan is solid. If you need help in evaluating that, we can do so. We do not write business plans, but we will help you with making sure that your business plan has everything in it that it needs to have. And then you're going to prepare in that business plan, along with your executive summary, your statement of purpose. How much money do you need? You're going to then collect all of your documents that are a part of the document checklist that we provided to you. Take a look at the links that is going to show you other samples of documents that you may be asked to complete. And so if you have questions on that, you can always schedule with one of us to just make sure that you're understanding the documents that you're about to prepare. And then if and when you're ready, if you feel you need some help or some assistance with any of this, after you've pulled things together and taken a look and evaluated what we've given you so far, feel free to register with us and set an appointment to meet with one of our advisors to help you further prepare for presenting to a lender. The other thing is that we work with several different lenders, banks, credit unions, CDFIs here in Columbus, in Ohio, outside of Ohio, that service small businesses here in Ohio, in our state. And so we may have some other recommendations for you, know some other products that might be available. Your job is to pull everything together. Ours is to help guide you through the process wherever you might want to go, or help give you direction on some sources that are available. I mentioned early on that the SBDC does have a microloan program that we offer. It's available for for-profit and nonprofit businesses. It's available for startups and existing, but it's crowdfunding. It's called Kiva. Kiva is a micro lending loan program. They provide a platform of which you are able to utilize to connect with friends, family, and community, and asking them to ante up. They said, hey, get started. We like your idea. We like your product. You should start a business. Now it's time for them to invest. And so this platform, you're able to utilize by using it to help raise dollars for your business. And now it still works as a loan. Kiva still takes you through an underlining process. They're still going to tell you what you're qualified for to lend on this platform. I'm sorry, to borrow on this platform, and you are paying the loan back. And as you pay it back, those that have invested in you, which they can do so, the minimum of $25, are repaid. But there is no fees, no upfront application fees, loan commitment fees. There is no prepayment penalty fees, and it is 0% interest. The thing with Kiva is it is short term, so you got to think about the payment and cash flow. Nice thing about Kiva is it is for a agricultural loan, you don't have payments for 6 months. If you are a small startup business, funding can be anywhere from $1,000 to $10,000. There's parameters in place for what funding level you'd be approved for. If you're an existing business or a business that has borrowed on Kiva before and successfully repaid your loan, you can borrow up to $15,000. Kiva can be used over and over and over again as you need it. Again, the whole process is always the same, where you're reaching out to friends, family, and community and asking them to contribute. I do a couple of different trainings on Kiva. We have one coming up in August that will be live at the Columbus Library, August the 15th. And then we also have it pre-recorded on our SBDC events page, where you can always access a Kiva webinar to learn more about Kiva. And you can also reach out to me at columbus@localkiva.org, and you can apply for Kiva at kiva.org/borrow Ohio SBDC. So that's available to you as another service that we offer at the SBDC, and you work with me directly on that program. So do we have any questions?
We do have a question in chat from LaShondra. She asked early on, when you're referring to an SBA-backed loan, what specifically does that mean, that it's SBA-backed?
Good question. That means that the SBA, in partnership, well, let's just say Huntington Bank, for example, is pledging a certain amount of money to them that if your loan should go in default, they would cover a certain percentage of it. So if you were to borrow a $100,000 loan, the SBA is coming in behind you as a guarantor like you are and saying, hey, we believe in this business. We'll provide 85% backing that if you go in default and you lose your money, we're going to give you back 85,000 of the 100,000 that you have allowed them to borrow. So that's what, when we say the loan is backed by the SBA, it means they are providing their support. So though they may be asking for your personal guarantor, they may even ask for you to collateralize and use your home. They're also going out there on a limb for you to provide an opportunity for funding.
Thank you. And LaShondra also asks, would the SBA assist with the $5,000 owner's contribution or owner's equity for a $50,000 loan?
No. So that requirement of a 10% owner's investment is going to be pretty much the same with many lending institutions that you go to. There's going to be very few that have a loan product that's not going to require some investment from you. So that is money that you would want to save up, that you want to set aside so that you have available when you go to pursue your funding. If you're pursuing funding in a very short period of time, let's say you started the idea at the beginning of this year and you've been buying items for your business, all that money and all those things that you've purchased for your business is the money that you have invested. And if you're keeping track of that and tally that up, you can use that often to say, this is your investment in your business. Now, if it goes past a year, then the likelihood of a lender accepting that is going to be slim. But if it's all within a year, you can usually get away with whatever you've been investing as you've been going, because it's bootstrapping, right? It's you investing in your business bit by bit. Oftentimes they'll consider that.
Thank you.
Mhm.
And I believe that is it
Okay.
from chat.
All right.
Well, I have one question before you go, if that's okay.
Okay.
This is what Chandra said. What if
No
you've been using your own personal services? Like for me, I have learned to create websites. Could I use that as a startup towards the 5,000? The websites, just all the websites, the flyers, the marketing, everything that I have been doing from my own talent that I would have had to pay somebody else to do for me. But because I learned those skills, I was able to do it myself. Would I be able to use that as startup or no?
Probably not. I mean, you can present it as goodwill, right? As time invested and so forth, but you're probably not going to be able to use that if that's not a skill that you are selling or a product you're selling in your business. So if you were to say, but I'm going to sell website designs in my business and I just took the time to learn it myself, well, that's different, right? Then we could talk about what cost you spent to gain that knowledge. If there was a certification involved and so forth, then we could maybe contribute some of those costs to that. But I get it. I get what you're saying, right? Is that you've saved a lot, and the fact that you've taken on these tasks yourself to learn how to do them. And I would still present it, right? I would present it in as time you've invested and time you've saved, and maybe offer some type of comparison. You know, the website you designed would have cost you $2,500, and you did it for your time, which was equivalent to maybe $800. I'd still present it, but it really just depends. They're still going to want to see it. Maybe it's not the full 10% that you have, but you're going to definitely have to show some type of liquid assets.
Okay, thank you so much.
You're welcome. Is there any other questions? Okay, and that's fine. If you don't have any questions for now, we've covered a lot of information. Again, you have our information. You can reach out to us. You can schedule time with an advisor to talk more about your business, where you're at, where you're headed. If it's not about just, securing funding, but you're still trying to pull things together. That's what we're here for. That's what our classes are for. So feel free to reach out to us anytime. So I just want to thank you for being with me this evening. Bruce, thank you for assisting me tonight. I really appreciate it. And again, spread the word. Now you're coming into the circle of entrepreneurship, and you're going to be attracting others to you that do the same, and believing in something that you can do for yourself versus working for somebody else. And so tell them about our resources, tell them that we're here to help and to take advantage of them. So thank you all. Have a good rest of your evening.